Okay, so welcome back to Investing for Independence, Basics of Investing in the Stock Market. This is week 2 of 2, which means this is the finale. We will definitely have the Saturday recap and Q&A, but as far as new information and new content, this is it. Tonight is it. So, no need to really go over the housekeeping rules because we're at the last night. And I believe everyone was here last week that's here now, but just in case, I'm gonna just quickly what to expect, basics of investing in the stock market to become a more knowledgeable and involved investor. You're going to learn the benefits that are associated with long-term investing, learn how to decide on and or set up a brokerage account to begin your journey as an active investor, what not to expect, how to get rich quick. We understand that wealth is obtained through knowledge and education. That's because we're woke. We're not gonna learn how to trade riskier strategies, high-risk strategies such as options, Forex, futures, day trades. I will be doing many small classes for options. There's 2 coming up this week. Good Lord. Well, one this week, one Thursday, one Sunday. And maybe in April, I'll do some other strategies. I've had a couple people ask, I'm still working that out in my head. There's no promises or guarantees in this course, and we'll go through the disclaimer, which is right here. You should know that investing in the stock market involves financial risk and is not suitable for everyone. Invest at your own risk. I am not a financial advisor or fiduciary. Any content that I share is for informational purposes only and based on my own personal observations. You should not construe any such information and or ideas as financial advice, and always, and I always underscore always, do your own research. Should you have specific questions regarding taxes, please contact a certified public accountant and or tax professionals. And tonight I got you. So here's the topic review. We got through week 1 where we, did the orientation. We talked about the basics and the beginnings of the stock market and the stock exchanges. We talked about why I invest and ways to invest. We also went over broker options. We had our Saturday Q&A and recap, which was fun. And then tonight we're going to go into some acknowledgements. We're going to talk about understanding the difference between long-term and short-term gains, creating your own investment plan and strategies, which always equals knowing your why before you do anything. We're going to talk about getting your mind right. That's your mindset management, because the people that tend to really lose out in the stock market are people that are not aware of the pitfalls when it comes to your emotions. And then we're going to get into brokerage accounts 101 again. We're also going to do a couple acknowledgements, a little bit of reviewing, how to decide what to invest in using the beginner's toolkit with a live demo. And then again, brokerage accounts 101 with final questions. And time for Q&A. But first I want to acknowledge our week 1 star students. You guys definitely, some of you showed up Monday and Saturday ready to engage, ask questions, and really begin this journey. Some of you called me on the side with questions that I know, make me know that you're serious about this and you definitely want to do it the right way. So I just want to quickly shout you out. Waramu, Pamela, Darren, Antoinette, Michelle, Tanshay, Tyrell, Sharon, Betty, and Sonia. Thank you again and that's not to exclude anybody else. It's just, I always like to, give people their stars who have, really showed out and actually validated this program and the time that I'm, providing to make sure you guys are woke. So we're going to start off tonight because I definitely believe that anyone who teaches you about investing and does not share with you how your taxes will be affected is doing a disservice. Even though I clearly talk about long-term investing being the way to go, I do understand there will be times that you may just happen to get into a stock that may run the heck up, and you may profit substantially, and you want to come out of that. And so what does that mean if you don't hold that stock for the long term? So with that being said, it's always good to have some professionals in the family, and no, that is not me with the bald head. That is my brother Cedric, who is an experienced tax professional. He started his retail tax business. I always get it mixed up. It's either 16 years or 13 years. He'll tell you when he comes off of mute. The name of his company is It's Tax Season. And we'll talk more about what he's offering to us as a group when he gets through his portion of the presentation. But he's, in addition to being a tax professional, he is a very successful investor. And anyone who decides to invest in the market, you want a tax professional that understands the market, like you really do. Otherwise, you could get hemmed up and Uncle Sam will come a-calling. So with no further ado, I'm introducing Cedric Smith, who will take it from here and clarify how many years he's been doing this.
Good evening, everybody. 16 years is right. I've been involved with the tax preparation business. So tonight, we want to go over how investing in the stock market affects your taxes. So first, we're just going to start and read from the presentation, and then we'll get into a little more detail. So what is a capital gain? Capital gains are profits you make from selling an asset. Typical assets includes businesses, land, cars, boats, and stocks. When you sell one of these assets for more than the price you paid to buy the asset, that can trigger a taxable event. This often requires that the capital gain on that asset be reported to the IRS on your income taxes. So when you open a brokerage account, at the end of every year, your brokerage account, if you made trades in that year, the buying and selling of stocks, whether it be long-term or short-term, which we're going to get into, your brokerage will send you what they call a 1099 form. And on that 1099 form, it will itemize all the stock trades that you made in the year. It'll give the date, how much you paid for it, how much you sold it for. This form that you get, they also send to the IRS. So the IRS already has this information. So when you do your taxes, and either if you do them or if you have somebody prepare them, when they submit your tax return, the information that is submitted, the IRS is just comparing to make sure that you reported correctly your capital gains or capital losses. So it's important that you're accurate. If you make mistakes or if your preparer makes mistakes, you will have to amend your return. Sometime, well, in the event that you underreport capital gains, what the IRS could do, or the states, is just send you a bill. Be like, okay, you had this amount of additional capital gains and you owe us this amount of tax. But you also have to amend it and amend your tax return and then resend it. And if it causes you to owe, you have to send a payment. Or if it doesn't, or if you, for some reason, some other adjustments happen, they have to send you some money. That happens. But just to be clear, when you buy and sell stocks and you receive a 1099 form, do understand that the IRS and in states where they have income tax, they already have the information. So please report it, because it's always better to just get it out the way and avoid additional fees and interest on money owed to the IRS. All right, so I'm gonna read the next one. What is a capital loss? A capital loss is the loss incurred when a capital asset, such as an investment or real estate, decrease in value. This loss is not realized until the asset is sold for a price that is lower than the original purchase price. So again, when you're buying and selling stocks, in the event that you buy a stock for a price and then sell it for a lower price, you realize the loss. Now, you only realize the loss once you make the sale. If you buy a stock for $100 and you see that it went down to $50, but you don't sell it, you haven't realized the loss, although you see it in your portfolio. The only way to realize a gain or loss, that means is like in the first pack, that is triggering a taxable event, is when you make a sale. So with capital losses, even though we don't like losing money, there's a benefit. There can be a benefit to taking a loss on stock sales, which means when you take a loss, it can offset other gains or ordinary income, like money that you make from work. So say, I'm just throwing a general number out. Say if you had a job and you made $10,000 in the year and you was buying and selling stocks throughout the year, and you ended up with a total loss of $2,000, instead of you being taxed on the $10,000 that you earned in income from a job, you would subtract the $2,000 loss from your investments against the $10,000. So instead of having $10,000 of taxable income, you will now have $8,000 of taxable income. Does that make sense?
Yes.
Okay, and one last point I'm gonna make with capital losses. In any given year, any given calendar year, the maximum loss you can take is $3,000. So in the event you had a year where you realize.
Another slide. Cedric, we have that on another slide.
Okay, all right, then I'll wait. Okay. We can move on. Okay. So here we're going to cover the difference between long-term and short-term capital gains. So what is the 2020 long-term capital gains tax rate? So a long-term capital gain is anytime you purchase a stock and you hold that stock for 365 plus 1 day. Anytime you hold the stock for longer than a year before you make the sale, it would trigger a long-term capital gain. It's a long-term capital gain. So there are different laws with the IRS and with states on how long-term capital gains and short-term capital gains are taxed. So investors are taxed at a rate of 0%, 15%, or 20% when profiting from a position held longer than 1 year. If you hold your assets for longer than a year, you can often benefit from a reduced tax rate on your profits. Those in the lower tax bracket could pay nothing for their capital gains rate, while income tax payers could save as much as 17% off the ordinary income rate, according to the IRS. So for long-term capital gains, there are 3 tax brackets: 0%, 15%, 20%. If you're a person that only has income that comes from buying and selling stocks, and in a given year, you only traded stocks, you didn't work, long-term capital gains on your first 40,000 of income is completely tax-free. That's that 0 tax rate, the first one.
I'm sorry, we have a slide for that too, so remember.
Okay, so all right, I'll just keep, all right, I don't want to get into too deep. All right, so we're just going to move on to the next: short-term capital gains. Short-term capital gains are for any stock that you buy and sell within the year. Short-term capital gains are taxed at a higher rate than long-term capital gains because short-term capital gains are added to your ordinary income. Excuse me 1 second, please. Come on, outside.
He's a dog dad, y'all. So.
Yeah, that dogs always know when you're busy. They always want to play when they know you're busy. So investors are taxed at ordinary income tax rate on short-term capital gains. For 2020, ordinary tax rates range from 10% to 37%, depending on your income and filing status. You typically do not benefit from any special tax rate on short-term capital gains. Other items to note about short-term capital gains: the holding period begins from the day after you acquire the asset. That's all I see. Is that the end of it? Okay. All right, so you want me to move on to crypto from here? Kim?
Oh, I'm steady talking. I'm sorry. Yeah, you can quickly go over this and then we'll go into the tables, which are next.
Okay. All right. So cryptocurrency, although used as a currency, Bitcoin is taxed like an investment and you might be liable for any profits made when you sell or spend it. The IRS considers Bitcoin to be property rather than money, so transactions are subject to the same tax treatment as other investment. Bitcoin taxes can be triggered by trading, exchanging, or simply spending the cryptocurrency. So documenting everything is essential. Bitcoin is taxed at the special capital gains tax rate, which is often less than ordinary income tax rate. Real quickly with cryptocurrency, if anybody's involved with cryptocurrency, this is new to the market, fairly new to the market. A lot of brokerage houses are still getting up to speed on how to deal with cryptocurrency. But when I mentioned about the sale of stocks, that your brokerage house sends you a 1099 for those transactions to report to the IRS, all brokerage houses are not sending 1099s for digital currency because they're still learning how to track it. So the brokerage houses are learning how to track it so they'll know how to report it to the IRS and to the states. But that doesn't mean if you do not get a 1099 from a brokerage house that you don't have to report it. It's still your obligation to report it, because if at any point the IRS or a state goes back and looked that you was making money off of Bitcoin and didn't report it, they're going to send you a bill. And if it's 2 years, if they have 3 years to investigate any year, it's 3 years down the line, they're going to send you a bill with interest and fees for those 3 years. So if you're trading any cryptocurrency, you need to be meticulous in your bookkeeping and record keeping on those transactions, because a lot of these brokerage houses are not even sending the 1099s with your capital gains or losses.
And I just wanted to add there, I don't know if anyone in this room has been trading Bitcoin, but through my conversations, people are trading, buying, selling Bitcoin as if there's no taxes, because there hasn't been really tax implications in the past. So I just want to make sure that if this does apply to you, or if you are looking to get into cryptocurrency, please note that Uncle Sam is trying to find a way to get his piece of the pie. So just wanted to underscore that. And then Cedric, I had a question for you. So let's just say someone's buying Bitcoin, but they're not doing anything with it. They're just buying and holding. Let's say somebody, bought $1,000 worth of Bitcoin last year, but it's just sitting in their wallet or sitting in CashApp or someplace else. Do they have to report it?
No. So again, to trigger a taxable event, you have to make the sale. So if you buying and you holding your Bitcoin, you never have to report until you make a sale, because the sale will also determine whether it's a short-term or long-term capital gains. But if you're buying Bitcoin or any cryptocurrency, say you bought a coin for $1,000 and then you saw a nice watch you wanted, and the watch cost $2,000, right? And the Bitcoin price appreciated to that $2,000. So you now take this coin that you paid $1,000 for, and it's worth $2,000, and you go buy a watch with it that's worth $2,000. That's considered $1,000 in capital gains. So you have to report that, and you have to be accurate whether it's short term or long term. Make sense? All right.
Yes. Okay, next slide.
Okay, here we have a chart of what the long-term capital gains tax rate looks like. So again, if you're a person that doesn't work and you trade and all your income comes from investing, and in a given year, all your investments that you triggered a taxable event were long-term capital gains, the first $40,400 is absolutely tax-free. This is why the rich stay rich. The first $40,000 is tax-free. The next bracket is 15%. This is for a single filer. And then you see the other filing statuses. If you marry, filing jointly, marry, filing separately, head of household.
I'm sorry, sir, can you repeat that one more time, the first part? Can you just repeat that one more time so they get it?
Okay, if you, in a given year, had all your income comes from trading, buying and selling stocks, and in this given year, all of your trades, or all your capital gains are long-term. So all the sales you made that trigger taxable events were from positions or securities or stocks that you held for a year. The first $40,400 of that income is completely tax-free. This is for the IRS. It's different state to state. Most states that, if you live in a state that doesn't have an income tax, then most likely you won't have a capital gains tax on the sale of stocks. So again, this first column addresses the 0% tax rate for each filing status, whether you file single, married filing jointly, married filing separately, or head of household. The next tax bracket, the 15% rate, is the same thing. From $40,000 for a single filer, from $40,401 to $445,850 is taxed at 15%. That's amazing. I mean, just imagine how much we pay on taxes for dollars that we earn when we go to work. This is why the rich stay rich. And then over $445,850 is all taxed at a 20% rate. When you work for a living, you get the 20% on like your first $20,000 of income. But this is how the wealthy stay wealthy and stay ahead. So long-term capital gains is taxed less than short-term capital gains and ordinary income. So if you have a long-term investment and you get to the end of the year, just be conscious of them dates, because 1 or 2 days could change a 15% tax rate to a 30-something% tax rate. So be conscious of the days you purchase stocks when you're making sales. Make sense? Okay. Oh, Kim, go back. Let me just give one more example with long term, excuse me. Again, so the first example I use is if in a year, all your income was from long-term capital gains. In the event you have a job, and say on this job, you made $20,000 a year, right? So that $20,000 is going to get taxed as ordinary income. So then, and say you made $15,000 trading stocks. So you take your $20,000, that gets taxed as ordinary income. Then you add your $15,000 of long-term capital gains. That puts you at $35,000. that 15,000 from capital gains is still tax free. Your income will be taxed as ordinary income, and your long-term capital gains, it stays under the rules of long-term capital gains tax rates. So that $15,000 is still tax free. If you made $20,000 and you say you made 30 grand in long-term capital gains in the same year, the 20,000 of your ordinary income is taxed at ordinary income rate. The next 20,400 is still tax-free. It's still tax-free, but everything over the 40,400 will then be taxed at 15%. So you had 20,000 of regular income plus 30,000 long-term capital gains. That brings you at 50. Your 20,000 of regular income from your job is taxed like ordinary income. The next 20,400 from the long-term capital gains is tax-free. And then everything over the 40,400 is taxed at 15%. Is that clear?
I have a question, please.
Go ahead.
Does that also include if you're retired, it'll still be the way that you're explaining the example of your working wages versus what you traded?
Yes.
Okay, thank you.
You're saying like pension income?
Right.
Yes, absolutely.
So if you're retired, there's no way you could get the 0% tax rate if you're receiving pension.
No. You can if it's under $40,400. You understand?
Yeah, I do. Okay.
If it's so
Don't know what to pay the man.
I'm trying not to over here.
Right. Yeah. If it's under 40,000, if your total taxable income falls under 40,400, whatever that portion of the capital gains that's under the 40,400 will be tax free.
I have a question.
Go ahead.
So long term is supposed to be 365 days plus 1 day. And if we're doing the taxes is just 365 days. So how are you?
So again,
tax,
so for it to be a capital gain in a tax year, the sale of the stock had to be made in that tax year. So in 2020, you had to have sold the stock. That means if it's a long-term capital gain, that means you had to buy the stock 366 days before that. So whenever you trigger the sale, that's the year it goes towards your tax return.
Oh,
whenever
okay. And it's
whenever you
determined
make
of how long you had it. Yeah, okay.
Exactly.
Okay.
The sale triggers the taxable event. So whatever year you make the sale, that's the year it affects your tax return. And then whether it's long-term or short-term, it depends on when you purchased the stock. You could have bought the stock 10 years ago, but sold it in 2020. So 2020 is the year that you have to account for those taxes.
Gotcha.
Should I go to the next slide or?
Yeah, you can.
Okay.
So short-term capital gains is taxed like ordinary income. So, we have what they call a progressive tax system in the United States, which means the more money you make, the higher your tax rate. So when you have short-term capital gains, what you do is, if you have earned income with it, say that same $20,000, your short-term capital gains, you just add it onto your ordinary income. So if you had $20,000 in earned income and $20,000 in short-term capital gains, wherever that 40,000 lands you in the progressive tax system, that's how you be taxed. So on $40,000 of income, if you have 20,000 of earned income and 20,000 of short-term capital gains, your top tax bracket would be 12% for a single filer. So if you follow this chart here, On $40,000 of ordinary income and taxable gains, the first $10,000 of that income, the first $9,875 for a single filer of that income will be taxed at 10%. From $9,876 all the way up to $40,125, you'll be taxed at 12%. And as you see how, the more money you make, the higher the tax brackets get, with 37% being the highest tax bracket. With long-term capital gains, the highest tax bracket is 20%. 20%. Yeah, there we go.
I just had to score that.
All right. Yeah. So.
Oops. Sorry. And I'm sorry, Cedric, can you just, after you finish going through the numbers, just talk about the extended filing date too?
Okay. So again, does anybody have any questions at this point about short-term and long-term? Okay, cool. Well, with that being said, the IRS has extended the filing deadline for this year back to May 17th. Okay, wash sale and what it is. Wash sale occurs when an investor sells or trades a security at a loss, and within 30 days before or after buys another one that is substantially similar. It also happens if the individual sells the security at a loss and their spouse or a company they control buys a substantially similar security within 30 days. Okay, the purpose of the wash sale rule is, okay, you remember how we talked about the taxable event? You only create a taxable event when you make a sale. So again, if you bought a stock for $100 and it dropped to $50, although you see the loss in your portfolio, the loss is not realized until you make the sale. So the purpose of the wash sale rule is, because again, when we talk about capital losses, there's a benefit of using a capital loss to offset other gains or to reduce your taxable income. So what the wash sale is trying to prevent is you buy a stock for $100, you sell it for $50. Now you realize the loss that you could use to offset another gain or ordinary income. But if within that 30 days you buy it back for $50 and it goes back to $100, you didn't actually realize a loss. You have the same amount. Say, if you had a share for 100, it went down to 50, and you sold that share at 50. You realize the loss. But if you buy that share back at 50, and it runs back to 100, you now have a loss you're showing that you could use as a tax benefit, but you actually didn't realize the loss because you still have the same stock. Does that make sense?
No.
So they want, huh?
Say it one more time.
Okay. If you purchase a stock for $100, right? And it goes down to 50.
Cedric, I'm sorry. Can you name the stock? Like, just make up a stock.
Okay.
Like Nike. There
you bought Nike at $100. You have Nike, and Nike drops to 50. You say, you know what? I'm getting out of this stock. I'm gonna take this loss. You sell it for 50. Now you realize that loss of $50. So this loss of $50, say if you was working and you had a job, you made $1,000. Now you have a realized loss of $50 from the sale of this Nike stock. You can subtract that $50 from your earned income, right? To reduce your taxable income. But what if you buy the stock right back at $50 and it goes right back to 100? You just realize the loss to benefit you to offset your taxable income, but you really didn't get the loss because you bought it back. You still have the same amount of asset and still could get back to $100. You understand? So they give you a window of 30 days that if you do that within 30 days, you will not be able to take the loss on that stock. You understand what I'm saying?
But if you purchase it 31 days out.
31 days out, you could take the loss.
Yes.
Right. So they want to avoid people taking advantage of a capital loss without actually taking the loss within 30 days. Does that make sense?
Yeah. So question,
Go ahead.
just about that. When it says substantially similar, does it have to be the same stock? What does substantially similar, what does that relate to?
Okay. A stock that's in the same industry, that's almost parallel, or it could be like, some companies have an A share and a B share. If you sell the A share and then buy the B share, that's substantially similar.
Okay.
So to put it in, I like to call companies out. If you purchased Walmart and sold it at a loss, but then you purchased Target within those 30 days and realized the gain, it's the same industry. You cannot claim a loss if you purchase a similar company within the same time. And that company doesn't even have to realize a gain yet. But if you purchase with the potential to make a gain within those 30 days, then you cannot write off the loss from the first company, Walmart. Did I say that right, Cedric?
Yes.
Okay.
Thank you. Thank you. It's interesting, especially when it says about spouses. So we got to watch what we're each investing in so we don't, screw each other over when it comes to that. So thank you for that.
Cedric, did you have anything else to add?
No, unless anybody has any other questions.
Well, I first want to just say, thank you, Cedric, for once again coming in and educating the people. I have been in so many stock classes over the years, and never do they ever have a tax professional come and speak to the people without, it's never happened. Let me just say that, not in my experience. So I appreciate you for coming in, because like you said, there's ways that the rich get and stay rich. And a lot of it has to do with playing this tax game as well. And the more you learn, the more you earn. And if you don't know about these tax shelters and how to use them for your own benefit, let me put on my, sorry, I didn't have the video on. If you don't know how to use them for your own benefit, then you can be hurt in the end. And so please take advantage, of a tax professional that knows this industry, the investment world, and is not just reading a book. I mean, Cedric has been a long-term investor and a short term. He also trades as well for many years. And so just to I don't know how many of you have already done your taxes, but I know like with the stimulus checks coming, the delayed filing dates, there may be someone out there who needs further assistance. And so, for investing for independence family, Cedric is super duper affordable. I mean, super duper affordable, to the point where I'm so upset. Like, I want him to be less affordable, but he understands, the value of being a voice for our community, so to speak. And when he opened his tax business, it was in the community of underrepresented individuals. And so with that being said, if you're interested in having your personal taxes done, his rate for 2020 is $125. If you're interested in a 15-minute consultation to talk about some concerns that you may have, that's $25. But it will, if you do decide to do the consultation and then have him do your taxes, the total will still only be $125. It won't be 25 plus 125. That will be, the $25 will be offset from the $125. And everything can be handled remotely. Praise the Lord. Nowadays, especially with COVID, everything could be either emailed or scanned and faxed. And just let me underscore the fact that if it is a business return, though, if you have a company, a business, those fees are determined based on the complexity of your business. Not every business is the same. So anywho, Cedric, do you have anything else to add?
No, that's it for the evening. Thank you for listening.
Okay, can I ask him, does he only do the tri-state area? Does he do other states?
Yeah, I was
Yeah,
wondering
any
that
state.
too.
I do any state.
Yeah.
Okay.
And I will make sure that the link to his email addresses, I did it the last session, so whoever got it last session, but for everyone today, I'll make sure his email address is included in the recap from tonight. Again, it definitely makes sense to speak. And, this isn't really just to sell him, but I just don't want us getting burned out in these streets. And I just see many of us that are going to get burned because we just don't know. And I've seen people who have been burned. You think you made all this money, and then when it's time to pay taxes, you didn't plan properly. So anyway, thank you so much, Cedric. Again, he's the owner of It's Tax Season, LLC. And I'm actually going to show an example of one of his very successful investments for his baby girl's account that absolutely is phenomenal. He won't let me see his account, so I'm sure it's phenomenal. But anyway, so we're going to move on. Any more questions before we move on to the rest of the content for tonight? Nope. Okay. So again, just wanted to recap these beautiful words and want to make sure that you guys are still reinforcing them. Like, I don't want you to stop because if you wrote them down, you think it's over. No, keep trying to embed them in your head. And like I said, during, I think it was Saturday's class, if you get these down, and you need 42 more, let me know. Because again, this is all about the more you learn, the more you earn. And so I don't want you to just stop here, but I want you to get comfortable here because this is where the money resides at a basic level. Now it's time for us to learn how to fish. We're about to go fishing in the stock market. I love saying stock market streets. I don't know why, but we're about to go fishing in these stock market streets. And we're going to do that through a woke investment plan. And just some of the key things that I like to share are, for us to remember, and we'll go over it again later on, but this is like my little sticky for your investment plan. Always remember to buy low, sell high. Now, that doesn't mean that you're buying this, like if it's a Tesla stock, yeah, we're not going to get that Tesla stock at $30 no more. That's not going to happen. But you also don't want to pay $900 at an all-time high. You want to buy stock when it's on a dip. You always want to plan, because if you fail to plan, you plan to fail. We're going to talk about mindset, because the thing that could screw you up the most, like I said, in these investing streets, is not having your mind together and your emotions in check. If you don't know, don't buy. It's just that simple. Please don't buy stocks that you don't know anything about because somebody told you to buy the stock. Please, 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 every successful investor, again, will tell you that's a sure way to lose money or be nervous and emotional in the buy. Always double check and always use a calculator. Whenever it comes to your finances, this isn't just in the stock market. Please don't try to do math in your head. You could be brilliant. You could have, been an honor student, have a PhD in math, but it's always good just to double check your numbers because calculations matter. When in doubt, ask an expert, meaning if you have questions about your brokerage account, if you have questions about taxes, if you have questions about anything related to your finances, please be sure to consult an expert. And experts are not hard to find, but just don't try to figure it out on your own. Use a credible broker. We went over the best in class discount brokers. We'll do that again tonight. Hot stocks eventually cool. Let me say that again. Hot stocks eventually cool. Don't ever suffer from fear of missing out, i.e. FOMO, because hot stocks eventually cool. Now, they may cool for a short amount of time and do another run, but no, wait for your stocks to come to you or a level where you're comfortable at, instead of trying to chase them. Stock streets are stoic. The Wall Street has no emotion. I said this in the last class. Wall Street don't care if you're black, you're white, you're male, you're female, you're gay, you're straight. It doesn't matter. All they care about is the money that you invest. There is no emotion. They are stoic and they will win every time over someone who's emotional. Always write your why before you buy. We'll get more into that. So into investing planning 101. So we did some homework. Most of us did some homework. And I'm just going to break down why that homework matters when you're doing your research and understanding your why before you buy. Recognizing the relationship between company size, return potential, and risk is essential when selecting investments for your portfolio. And that's not Kim saying that. This is a direct quote from fidelity.com on why market caps matter. And when you get the link to this presentation, when you get, this actual presentation sent to you, the link is included. All you'll have to do is click on this right here and it takes you to the article. But again, understanding the relationship between company size, which is market cap, return potential, which is the price history, and risk is essential when selecting investments for your portfolio. And risk could also be considered price history. So we went over, this is the homework that you were given to do. The first chart to your left is your 20 stock picks, where you wrote down the company, the ticker, also the current price of the stock and the date. And that is your overall watch list. Those are your 20 stocks that, again, barring any financial issues, if you could own these companies, you would own these companies. And again, why do we do stocks that we like? It's because these are the stocks we don't mind researching. If you are really into Nike and you're a sneakerhead, then when it comes down to doing research, it's not going to seem tedious to you. It's going to seem like, especially once you start getting into it, people from the February class have called me like, I can't sleep. I've been up I was up till 5 o'clock in the morning researching my company. So again, and that's what you want. And that's even what Warren Buffett says. And we talked about that last week. And I'm going to reference, the Don Dada Warren Buffett a lot because he has definitely cracked the code as it relates to long-term investing. And then we drilled down to your top 12, which is your focus watch list, meaning these are the 12 that you are going to try to learn inside and out. And when I say inside and out, you're going to, know these 12. You could recite these 12. If somebody, said, recite the 12 companies on your watch list and I'll give you $1 gazillion, you'll be able to do that after you finish, your investment plan. And you're going to keep an eye on these. You're going to monitor. And once you open your brokerage account, these are the 12 companies that you're going to have in your watch list. And I'll show you what a watch list looks like a little later on in a screenshot. But, and as it says in the last image, you want to know what you own and why you own it. And that's going to come with your thesis, which we're going to talk about. That's the second half of your homework that you're going to be given tonight. And I wrote who Peter Lynch is. He's another brilliant investor and basically has also cracked the code of the market. And here's, Warren Buffett again talking about diversification and concentration. So while the 12 that you select should not all be the same type of companies, meaning you don't want Ford, GM, you don't want all automotive companies as your top 12. You want to have a diversified list. You're going to have that diversified list, but you're not going to invest in all 12 of those companies. You're going to concentrate that list. Diversification may preserve wealth. So once you're wealthy, it doesn't matter if you have 120 stocks or 12 stocks in your portfolio based on your, financial level. But to build that wealth, you need to concentrate. And I guess to put it like in ABCs, like if you have 2 shares of Apple stock that you bought at $100, and it went up, you know, to $150 per share, you made $100 on those 2 shares. Whereas if you just had 1 share of Apple and 1 share of this and 1 share of that, that diversification may be at an expense because the other shares may not move as fast or as much. The price performance or the price action may be a lot lower than that Apple share. So we want to first want to concentrate our list. So from that 12, you may be looking at investing, and depending on your financial appetite, you may be looking at potentially 3 to 5 of those companies that you are going to invest in over the next year and keep investing in. So diversification also includes the types of sectors or the type of companies that you invest in. And of all the sector, all of the types of sectors or industries, there are 11 classifications that you look at, or that you are able to segment. So the top 11 are listed here: materials, industrials, financials, energy, consumer discretionary. So that means like the retails, information technology, consumer communication services. So that's like, it could be entertainment, real estate, healthcare, consumer staples, and utilities. You want to make sure that your portfolio is balanced. So let me just read the top. A diversified stock portfolio will hold stocks across sectors. Diversification across stock sectors help to mitigate risk caused by factors affecting specific industries or companies within an industry. There's something called sector rotation. So there's times when one sector may be up and one sector may be down. If you follow anything about the market over the last month, there was a whole talk about the 10-year yield going higher, which caused the financial sector to go up, while the tech sector, which has been on a serious boom for the past year, took a huge hit. But that's okay, because you're still making that compound interest, and you just have to ride the wave. And that's why long-term investing is so important. Now, we talked about stocks specifically, but I also want to talk about ETFs and mutual funds real quick. Well, specifically ETFs. For those of you who are interested in buying stocks that may be cost prohibitive at this time, because I mentioned that while I'm not against fractional shares, I don't invest in fractional shares for my portfolio because there are so many other opportunities out there. So let's just say you can't, you're interested in Amazon, but Amazon is over $3,000 right now. Not many people can just go out and buy 10 shares of Amazon without blinking or without really thinking about it. But you know what you can do? You can find an ETF where Amazon is heavily weighted so that when Amazon moves, that ETF moves. But that ETF may only be $100, $50, $200 per share. And you could buy and sell those ETFs. Those are exchange traded funds, the same way you can buy and sell Amazon. And I was going to do the link now, but I want to get through this. And then if somebody reminds me if they're interested, I'll pull the ETFDB website up and show you what that looks like. And the link, it will be, again, in the presentation that I sent. So again, the passive strategy, which this also talks about. Wait, who was that?
Oh, that was me, Yolanda. If you, I was saying I was on mute, then I kept saying, oh yeah, I would love that. But yeah. Okay,
perfect. Listen, we were on this call till 11:35 last week. Not that everybody could do that, but I'm here until questions are answered. So just remind me though. So passive strategy, if you're an investor looking for a simple way to diversify your portfolio, funds may be the way to go. And that's both exchange traded funds and mutual funds allow you to own shares in a broad range of companies without having to buy each individual stock yourself. And it's up to you to decide if you want to be an active or passive investor. So if you want to be a passive, then you're looking more like a mutual fund or a fund that tracks the S&P 500 or the NASDAQ, which we talked about last week. But again, you can also trade ETFs as if they're stocks. We still want to hold them for a year so we don't get hit with those capital gains taxes. But still, after a year, if you want to switch into something else, sell, you can do that on your own with no problem. So the homework review, we talked about shares outstanding. We talked about market capitalization. Let's just go over the definitions real quick. Shares outstanding or outstanding shares, which are, it's used interchangeably. A company's stock currently held by all of its shareholders, including share blocks held by institutional investors, meaning like the JP Morgan Chases and the big banks, and restricted shares owned by the company's officers and insiders. So there's a certain amount of shares that the CEOs and the board holds. So think about when Beyonce was announced as a spokesperson for Peloton. Trust and believe they paid Beyonce with some shares of Peloton, and they did not go to the stock market to purchase them. So most, if not all companies have a certain amount of shares set aside to be used for employees, for payments and things like that. Market capitalization is simply how much a company is worth determined by the stock market. It is defined as the total market value of all outstanding shares. All of the shares that I just discussed above represents the total market value. And to calculate the market capitalization or market cap, you simply multiply the number of outstanding shares by the current market value of one share. So we're going to go through how to do that in a second. But are there any questions about what I just said? Perfect. Okay, so now let's really get into why outstanding shares matter, and then why market capitalization really matters. The amount of shares outstanding is one of the more overlooked aspects of investing. A lot of times, novice investors just simply look at the price of a share and see, oh, it's expensive, oh, it's cheap, or if this stock is worth, or if this stock is going for $200, that means the company's more valuable than the stock that's $50, which is so not true. And we'll get into examples in a second. Investors often pay attention to a share price and a company's profit or sales growth, but they may not always notice if the amount of shares is growing or decreasing. A fast rising share count can sharply dilute the value of all other shareholders' stake in the company, i.e. the stock price. So be sure to keep an eye on the share count on a quarterly basis while you own a particular company. And this is quarterly basis, but you can do it biannually if it's a stock that's been around for a while and they have a certain pattern. But for these newer stocks like these SPACs and these DPOs that we talked about last week, keep an eye on them, because it's basically what they call supply and demand. The more shares that are just out there floating, the price is going to be lower because the demand is also lower. The least amount of shares that are out there floating drives the value and the price of the stock up. So think about when companies, if you've ever heard a company doing a stock buyback, a lot of times companies do that to boost the price of their sales because they're feeling undervalued. So I think recently, or 2 weeks ago, GM was going to do like that was a stock split. But if you do a stock buyback, that you're taking shares out the market to rev up the value of that stock, but that doesn't make the stock more valuable. It just means nobody wanted those shares that were in the market. And it could be a tricky way to get people to think that the price is going up when it's really not. So let's talk about market cap and why that matters. When you're evaluating a publicly traded company and deciding whether you want to purchase a share of its stock, you shouldn't focus solely on the price of an individual share. Make sure you look at its market capitalization or market cap to get a more clear picture of how the market values the company. Investors can use a company's classification and actual market capitalization value to make smart investment decisions. Generally, large cap companies own more capital and assets than small cap companies. And we'll show you how to distinguish those. And as such are considered lower risk investments than small cap ones. So if you have a large cap company, the risk level for large cap companies compared to small cap companies is much lower. Moreover, small cap companies tend to show higher growth potential than their larger counterparts, and as such are likely to provide investors with more opportunities for capital gains. So while small cap companies are more risky, they tend to have more room to run. If you have already at the highest level of capitalization, you have less room to run. So it's, again, up to your risk tolerance and doing the homework about the company you're investing in before, that's up to you before you make a decision as to what to buy. Given its simplicity and effectiveness for risk management, market capitalization can be a helpful metric in determining which stocks you're interested, and I can't see the bottom part, you're interested in purchasing, I'm just gonna say, because I can't see the last line. But anyway, saying all that to say, market capitalization matters because it's gonna tell you the risk profile of a company. Overall, generically, that's not to say it will definitely happen. So while small caps are more risky, it doesn't mean that you're going to lose your money. It just means that they haven't proven themselves like large caps have. So market cap matters. Continuation. What is market cap? Market cap equals the share price times the number of outstanding shares. The size of a business's market cap determines which broad category of publicly traded companies it will fall under. Every company that's traded on the stock market is either classified by small cap, mid cap, or large cap. Some firms will say mega cap if it's, the super big companies, or micro caps if they're super small companies. But on a day-to-day, if you're listening to CNBC, very rarely do you hear micro cap, and micro cap is usually just lumped into small cap. But those are defined, mega cap and micro cap are defined as the absolute smallest and biggest publicly traded companies. So let's consider some examples. Let's take two companies with very different stock prices, yet somewhat similar market caps. So stock A has a stock price of $50 a share. They also have 50 million outstanding shares. You take the price of the stock per share times the outstanding shares to get the market capitalization. So $50 times the 50 million outstanding shares will give you $2.5 billion in market capitalization. Let's take stock B, or company B. The stock price is $10 a share. The outstanding shares is 300 million. So you take the price of the share times it by the outstanding shares, that would be $10 times the 300 million, and that would give you a market capitalization as $3 billion. Now, if you only looked at their price per share or their share price, you wouldn't know that the second company was the more highly valued of the two. And that's something that so many new investors or unwoke investors, let's just say sleeping investors, do not understand. They would automatically assume that stock A, which has, is considered or more expensive, quote unquote, at $50 a share, would be valued higher than the company or company B, which is only $10 a share. So 2 more examples. Consider, once again, these 2 companies with very different stock prices and different market caps. Stock price for company A, or the first, I'm going to say C because I already used A and B. So stock price for company C is $50 a share. The outstanding shares is 10 million. You take the $50 per share times the outstanding shares of 10 million, the market cap is $500 million. Company D, where the stock price is $10 a share, outstanding shares is 300 million. You take market cap $10 times 300 million, and that gives you a market capitalization of $3 billion. Once again, if you looked at the price per share, you would automatically just assume for the novice investor that the stock that costs more is worth, the company is worth more. And again, that is not the case. So there's levels to market capitalization, and let's talk about them. Let me just move this thing, okay. Large cap, you may hear on CNBC or Yahoo Finance TV or some other, Bloomberg, you may hear it also be referred to as big cap. Those are simply corporations with a market capitalization of $10 billion or more. One distinguishing factor about large cap, AKA big cap, is those companies are the ones that tend to offer dividends as an incentive for investors. That's because they have the money to do so. So that, I think last week I was talking about dividend investing. So if you own a share of stock, and I'll give Apple as an example, if you own one share of Apple, every quarter, Apple will pay you a dividend just to be just for being a shareholder as a thank you, or call it profit sharing. Okay, it's only 22 cents that you get per share. However, if you own thousands of shares, that 22 cents every quarter is a nice piece of change. And you could either reinvest it or use your dividends to, pay some bills or, live your life. Let's look at mid cap. Mid cap are simply corporations with a market capitalization of $2 billion to $10 billion. And those are more risky than large cap. But again, they're sound companies. When you have a market capitalization of $2 billion to $10 billion, those are still pretty safe companies. And we'll go through some examples in a second. Then small caps are those corporations with the market capitalization between 300 million and 2 billion. Some people, I changed it. So up until about some months ago, it used to be 250 million to 2 billion, but it's now, the universal law now is 300 million to 2 billion. So some things you may see 250 million, but universally it will be accepted as small caps will be accepted as those companies between 300 million and 2 billion. And small cap companies generally will not offer dividends as an incentive for investors, but they also have more room to run, meaning the profitability can be greater for people who are willing or who are not averse to risk. If you're okay with some, assuming some risk, because these companies haven't been proven yet and they don't have the same type of assets as larger caps do. And mega caps are over 200 billion. So between 10 billion and 200 billion, that's large cap. Anything over 200 billion is mega cap. Anything under 300 million is micro cap. So what do they mean? Large caps are stocks that have less potential for price appreciation, but are considered to be safer investments because of their long track record of success. So less potential for price appreciation, meaning whereas a small cap company, and we'll get into that in a second, you may see that stock fluctuate 50% in 1 year and beat the average for all of the indexes, the S&P 500, the NASDAQ, and all of that. Whereas a large cap company may, and I say only in quotes, may only deliver 12%, 15% over a year, unless it's in a growth category, but we'll get to that. Whereas small cap companies, these stocks in general have greater potential for price growth because the companies themselves still have room to grow, but may also be riskier investments because of the uncertainty of the company's future performance. That's because they simply don't have the assets. Like I always love talking about Apple. Apple has, I don't know how many billions, is it like $30 billion just sitting in a I was gonna say a safe, but being invested. Like they have no debt. So at the end of the day, their risk is very, very small. The chances of them just going out of business for any reason in the next decade is slim to none. And then mid caps. Mid caps are those that fall in between the small cap and the large cap. And they also, let me just read it. Stocks typically fall in between small caps and large caps for those growth and safety parameters. So mid caps, again, they have a whole lot of valuation. They tend to be profitable. They tend not to owe that much. And not all debt is bad debt, but if they do have debt, it's good debt, not bad debt. And so they're safer, but still more riskier than the large cap. And so before I move on, and well, let me just go through examples of the mega cap, large cap, mid cap, and small cap companies. You could look up micro cap on your own. That'll be part of your homework assignment. But mega cap are those 200 billion up. Over 200 billion. So they're bigger than the large cap. Those are the Apples, the Johnson Johnsons of the world. You have large caps that are between 10 billion and 200 billion. Those are companies like Sony and Pfizer. You have mid caps between 2 billion and 10 billion. That's GameStop and Papa John's, just for examples. Small caps under 2 billion are companies like Dave & Buster's and 3D Corp, Systems Corp. So what I want you to do also with the homework assignment that you just did, I want you to indicate if your company is where they fall in this large cap, mega cap, small cap, mid cap sector, and that will help you with your diversification. Now, before we go on to price performance, which was also part of the homework, are there any questions?
Kim, where would you find if it's a large cap, small cap, mid cap? Exactly where you look at. I mean, what site?
Wait a minute, Pam. Didn't you do the homework? Didn't you say?
Yeah, I did. I'm just a guy confused, I guess.
That was the bar chart.
Okay.
But we could go over, I mean, there's multiple ways to find it. You could really Google the company and just put, Google's market cap or, GameStop's market cap, and, you'll get a result in Google. But we use bar chart because I want you guys to start using bar chart. So let's quickly look at the, any more questions? I'm sorry. Nope. Okay. So why does historical price performance matter? Looking at the past is helpful. It's never a guarantee, but it's helpful when analyzing specific companies. Why? It's because the past offers guidance to a company's future performance, particularly when results have been reasonably steady and the company has an economic moat. A moat just simply means the ability to maintain a competitive advantage and to increase the likelihood of it continuing to produce such results in the future. This is why I asked you guys to do the 3-year, 5-year, 10-year price performance, because it's going to give you guidance. It's going to let you know if, some of you have stocks that have been negative 3 years, 5 years, and 10 years. You are going to replace that stock with another stock from your top 20. We are not investing in companies that can't be profitable at all. So if you couldn't even be profitable in a 3-year window or a 10-year window, which gives you the time, a wide span to be profitable, these are not good companies. These are not good companies at this time, and these are not companies that you should be investing in. And so I want you to replace those with another company from your top 20 and do the same exact thing. Do your research and throw that one away for now. Okay. Add to the past add to the past, the present in the form of financial soundness and the shares being reasonably priced, and you are starting to take a factual, logical, and sound perspective on whether to invest or not. These are all woke strategies. These are all educating yourself on the particular stock that you're interested in buying. And some things we like may not be the best investment for us, but at least we'll know that before we spend money investing in it. And so, let's just quickly sum it up. I'm trying to move this thing out the way. Okay. So we first looked at the stock prices, including their highs and lows. That was the first part of your homework. We also looked at the exchanges that the stocks trade on. So is it on NASDAQ or is it New York Stock Exchange? We then looked at the company's market cap and outstanding shares. We also looked at the historical price performance. All of these, well, the historical price performance is going to give you guidance. The market capitalization is going to give you risk tolerance levels. And all of this information, when combined, will help to evaluate the strength of the company before making a decision and help to diversify your watch list. As part of your investment strategy, you will monitor the above periodically. So again, we're long-term investors. We don't have to look at the stocks on a daily basis. We don't have to look at the stocks on a monthly basis. We don't have to look at it really on a quarterly basis unless you're involved in riskier stocks. So if you're in those micro cap or those small cap companies, you may want to check more frequently to make sure the company's still around, they didn't go bankrupt, stuff like that. But for the most part, you don't have to watch these companies like a hawk once you do your homework. So I am going to now stop sharing this screen and give you an example of how we back test stocks to see what performance can look like over the time frames collectively in one portfolio. So give me a second. I'm going to stop sharing this screen. I could do a new share. Hold on a second. Let me just do the new share. Okay, can you see that screen? It changed. Do you see it in the screen? That's exactly perfect, perfect. So what I did was the Cottons literally got their homework to me in like Speedy Gonzalez time. And so I'm using their list or a portion of their list as a case study on how you can back test. So I'm just going to take you through what we're looking at. One, we're looking at a year-to-year time frame. So it's not like fiscal year, it's year-to-year, calendar year. And we're starting in 2015 and we're ending in 2021, but we're not using year-to-date. So it's really ending in 2020. Let's just be clear. And so you know what? Let me just go ahead and change that. I'm not changing anything else. I'm going to do analyze. Okay, so let's go back up here. So we started with $1,000. We just, there was no STEMI back then. Well, we got a federal tax return and we put $1,000 into the market. We each and every month contributed a fixed amount of $200. We adjusted it for inflation. And again, it's monthly contributions. We rebalanced annually just means the stocks are evenly balanced and the investments are evenly balanced out across the stocks that we picked. We reinvested any dividends that we got. So if we got those, 18-cent dividends, they went right back into our portfolio. And let's just go to the first one. So what I did was for the first portfolio, I just picked 5. I think I went every other stock on the list or something up until 5, because again, we want a concentrated portfolio. We don't want a portfolio that has one share this, one share that, maybe this could have been 6, maybe 4. But I used 5 of the 12 that were provided. The companies are Tesla, Target, Nike, XPO, AMD, and AMD for the top 5. We kept it evenly weighted, distributed 20% for each company. And then the second portfolio is Prudential Life Insurance, J&J, Square, Boeing, and Exxon Mobil. And once again, 20% evenly distributed across the portfolio. So let's just look at portfolio 1. As you can see, this pie represents 20% of each company: Tesla, Target, Nike, ExxonMobil, AMD. And portfolio 2, the same, 20% of Prudential, J&J, Square, Boeing, and ExxonMobil. And I intentionally picked I picked 2 separate portfolios that represented different sectors, different industries, so that you can see, while there may be variations, the profit margins are still much better than you can ever think about getting at a bank. So let's just look at the returns for portfolio 1. So remember, we did the initial investment of $1,000. Then over 6 years, we put $200 a month into this account. I'm trying to find the total. Hold on a second. Here we go. We put $200 a month every month into our brokerage account. At the end of 6 years, with a total investment of $16,400, the balance is $83,690.
That's what we do.
So Kim, I know. So Kim, if let's say, because I'm starting out 1,000 also, but you're not able to do 200 a month, right away, or you don't do a few months, but you start up again. What do you feel about that?
Well, I feel like you'll be able to do your own back testing based on your own where you are, your own financial profile and your risk tolerance and all in the companies you want to invest in. And so once you get this link, you'll be able to literally put the companies that you're interested in investing in the time frame that you want to review, with the amount of money that you want to invest or you're capable of investing. And that will give you an insight as to performance. It's not a guaranteed performance, but it's an insight into performance. And that's how every financial manager is able to say to you, oh, this money market account or your 401k should deliver this amount over this amount of time, because they back tested it. They're looking at historical performance, price performance. And so that's what you'll be able to do as well using this website. So,
thank you so much.
Oh, you're welcome. So looking again at portfolio 1, you had a compounded average rate of return, gross rate of return, I think that's what it is, of 142%. All these other things are listed down here. I'm not going to go because they get very technical and could get very boring. But if you need to know what all of these acronyms stand for, then you could just look under the notes. But the most important thing is what we talked about, the compound interest. And it's adjusted, like I said, with inflation. The best year of those 6 years, your portfolio delivered 195% return. But guess what? The worst year, when I say only, it's still more than the bank, you only delivered 14, almost 15% return. And that's how this market works. And once you understand this, you do not fear the dips. You do not get upset when the market goes down, because you're in it for the long term. Now, if you're a short-term trader and you got a lot of money tied up, yeah, your heart may palpitate a few times. But as far as long-term investing, which is what I'm supporting in this program, then this is what we're looking at. But let's go ahead and look at another portfolio, the other portfolio, which didn't have the same type of returns. And just looking at the companies, we know Boeing took a massive hit in 2020. We also know, well, I don't know if we know, but the oil industry took a massive hit in 2020, which I'm sure so did the insurance and financial markets. So understanding that these 5 years, this portfolio, the rate of return was only 91%. And I say that laughingly, over 6 years versus the 142%, but that's okay because everything's cyclical. Who's to say? Now, I'm not saying, let's be clear, I believe in Boeing. I don't know what the oil industry is going to do. I really don't know what Exxon, I'm not in the oil industry, but I do know that it may be challenging because everything's going solar and, more green, so I'm not sure what's going to happen there, but let's just look at the history. 91% over 6 years is amazing when you're getting less than 1% at the banks. Or let's say you got 2% at the banks. Heck, let's say you had a 5% CD somewhere at some bank for 5 years. It's not 91%. The best year, 56.68%. The worst year, 5% return, which is still higher than that CD I just referenced. And then this is just a comparison side by side of the growth and the charts. So basically, this is what you can do to kind of get an insight, not just into an individual stock's price performance, but collectively if you had a portfolio of said stocks.
Kim.
Yes.
I know that, my question is there a similar tool that you can use for companies that say are fairly new? All of these companies have been around for a while, so it's pretty easy to say, for instance, go back over a period of 5 years. But when you have, a really new company that you may be really interested in, is there some type of something similar to this that you can use for these new companies?
So I don't believe Square has been around. Has Square been on the market for 5 years? That was Warmel. Do you remember?
No.
Yeah.
No. Well, it gave me a 5-year number, but nothing for 10.
Oh, okay. So yeah, so not all of these stocks are 5-year, 10-year. It will adjust your investments based on the introduction of the stock. So the system knows that for the first year, Square was not included as part of this investment.
Uh-huh.
5th year, 2015, so 2016, I'm just assuming, I don't have the numbers in front of me, but based on what I was just told, Square was not involved in the 20% part of your investment until 2016.
Okay.
So it will adjust.
I got it. Okay.
Uh-huh.
Mm-hmm.
Now, if you just have all new stocks, it will also adjust. You will have no returns really for, let's say this is a 6-year time frame and all your stocks are 2 years old. Uh-huh. Your interest will not start showing up on those stocks until 3 years later, 4 years later. I said 2-year-old stocks, right? 4 years later. Okay. So yeah, but this will take all of that into consideration.
Kim, it actually says it in the blue, that blue highlighted section, because of Square.
Oh yeah. Mm-hmm. Note the time period was constrained by the available data for Square, December 2015. So all of that exactly is included as part of this algorithm to figure out what your return would be even with newer stocks.
Right. That's good. Okay.
Okay. So that was the case study on how to, let me get back to new share, get back to the presentation. And this is a great tool for you to use as part of your strategy and knowing what the site is called portfoliovisualizer.com. But again, this is a link where to take you straight to the site. Now, we just gonna talk about how, you know, when all of this is done and we realize that we're about to make some trades, we're gonna know that we may have a whole bunch of other problems, but understanding our investments won't be one of them, because we're gonna know these companies as part of our investment plan and strategy. You know, even if it's not inside and out, you're gonna be comfortable when you make that trade. Every woke investor starts with a plan. And if you were in the class last month, don't answer this, but has anyone ever heard of the 7 Ps? And if so, do you know what they are?
That's only 6. No, I only got 6 Ps.
Well, the funny thing is there's also a 6 Ps, but the 7 Ps is the one I like the most. And one of the words probably, what's the 6 Ps? Let me hear.
Proper preparation prevents piss poor performance.
Extra credit.
Prior. Okay.
And preparation would be the same, but prior proper planning prevents piss poor performance. And you can ask Jill about that. Jill dotted her I's, crossed all her T's before she took her company public. And she made sure, even though, you know, through the video, y'all saw she tried to water down some stuff and this and that. But, you know, in order for her to get her company to the next level and go public, she had to properly plan. And let's just listen to Uncle Warren. Okay, before it plays, can y'all see? What do y'all see? Do y'all still see Warren Buffett?
No, the video.
I see the video now is playing.
Okay, perfect. So let the commercial play and pay attention. Can you hear it?
Yes.
Okay.
Yes.
Way of doing it. What are they missing?
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
Hey there, thanks for checking out CNBC.
Hold on a second. So I'm going to stop sharing for a second because I want us to talk about that for a second. Can y'all just tell me what y'all heard?
I heard that he doesn't feel too many people are intelligent enough because they stop or they give up as soon as they see something negative instead of seeing the long run.
But what did he say could be the solution for that?
Becoming educated.
Educated in it, yeah, and what you're doing. Mm-hmm.
Listen, I'm about to send Uncle Warren a woke T-shirt for real, because that's what this game is about. So again, you may hear, you know, some people say it different ways, but it's the same exact thing. You can't. This is not rocket science.
Right.
If you get your emotions in check and keep understanding that this stock market came around when did the New York Stock Exchange?
1791.
1792.
Yes, you're a little early, Sonia, but
okay.
Thank you, Michelle. Yes, 1792. This is where the wealthy people reside. There's no racism. It's not like the black people gonna come and start investing and they go shut it down because that means we all gonna be poor. And so all you have to do is the work. And so whoever has not done the homework, don't start trading. Please don't. I don't want you to buy nothing until you do the homework. And I'm not giving y'all the homework just for no reason. This is how I trade. This is how Uncle Warren done told y'all to trade. And for those who weren't on the call Saturday and are new, Warren Buffett's company, Berkshire Hathaway, is the most expensive, highly valuated company on these Wall Streets. One stock, one share of his Class A shares is over $250,000. Let me repeat that. I didn't say 2,500. One share is over $250,000. So when he says that, and he's been riding this roller coaster, he turned 90 this year. Yeah, he turns 90 this year. He has been riding this roller coaster since he's been in his 20s. So listen to the wise words of the Don Dada, Warren Buffett. Did anybody else want to comment on what he said? Do y'all want to hear it again? Did y'all hear it? Let me know.
Was letting go emotions, being more logical.
Exactly.
I like what he said about the $20,000. There's no way in hell that if I pay 20 grand for my house, I'm gonna go for 10 because of something I could crash. This is my investment. So I'm gonna ride it out till the wheels fall off. And when the wheels come off, I'm gonna put them back on and ride it again. There's no way in hell I'm doing that. This is my investment. So now I realize I'm an investor, didn't even realize it.
See, 100%. Your real estate, you mean?
Yeah.
Oh,
exactly.
absolutely.
Exactly.
Absolutely.
Exactly. The more I put into it, the more it's worth.
And unless there's some type of catalyst that changes that. So let's just say, now keep in mind, he said, I bought the house for 20,000. Someone just comes and says, I'll give you 15. My house is still valued at what I paid for it, if not more. And there's no reason for me to sell it to you for 15. Now, if you in a hurricane zone and you done found out that every season your house is going to flood, you're going to have to spend more money, keeping it up to code and making sure things don't get destroyed, then maybe I need to sell this house. But if there's no catalyst to make you sell the house, then you don't sell the house. The same with companies. It may, things may fluctuate, you ride that roller coaster, but unless there's something that makes that company no longer valuable based on the homework that you did, then like you said, ride it. You keep riding it out.
Yep.
I know one of the first things he said was that, some people just aren't built for this. They
emotional.
Handle it. They're not emotionally strong enough to handle.
Because and the emotions leave when you do the work and you educate yourself. Now, some people just don't want to do the work. And that's why I said, the first classes, I know for certain, as much as I want everybody in this room right now to come on this journey, Lord knows I want y'all to. Some may come, some may not. Like they said in college, you look to the left, you look to the right. I don't know the percentage of the people here, but I do know not everybody is ready to take this journey. They, this may spark something, and maybe a year from now, 2 years from now, they may be ready. But I do know that it's a journey worth taking. And again, that's why I try to keep giving you, nuggets from people who have been doing this much longer than me, that have created and generated a mass amount of wealth. And let's be clear, Warren Buffett didn't start out a millionaire, a billionaire. He started out in a small farming town in, I believe, Omaha, with $100. So now keep in mind, he started in his 20s, so he had more time on his hand, but this is for the youngins. Listen, y'all, this is doable. So anyway, I do want to finish this presentation, so let me get back to that. Where the heck is it? Un momento, por favor. Is it on this one? Oh, I gotta close out of this. Hold on. Okay, here we go. Share screen. Okay. Thank you, Uncle Warren. So let's quickly go through other pitfalls of the sleeping investor. These are the not woke investor mindset, mistakes made by new investors, and not all new investors. There's a lot of investors out here that have been out here for a minute, still trying to time the market versus putting time in the market. And these are pitfalls that we're not going to make as investors. Number one, we only buy hype stocks. No reason to do that. It's like, you know, hearing that this part, you at home and you hear, it's like 2 o'clock in the morning and you hear, I don't know, I'll just use Morris Chestnut because some of y'all know how I feel about her. It's 2 o'clock in the morning, somebody's in Brooklyn, I'm in Westchester, they like, oh, Morris Chestnut is at this club. And I'm like, really? And I start getting dressed. I'm not even dressed yet. I'm in my pajamas. Got to, you know, put on my face, put on my clothes and drive to Brooklyn. Is he still going to be there when I get there? Probably not. And for those of y'all that don't know New York, that's probably like at least a 2-hour process right there. Yeah, I'm getting to the party when it's too late. The party's over. Like hype stocks are stocks that literally keep Wall Street rich, basically, because people get in when it's hyped and the price is high, and then that price goes down, and then they're upset because that wasn't money that they really could invest, and now they have to wait a good 6 months, 8 months, 12 months for it to go back up. So anyway, we're not buying hype stocks, we're buying stocks that we've researched and we feel comfortable and we know that we're getting it at a value. When the stocks go low, we run. So selling on the first drop, we get scared. We lost, you know, I don't know, $500. We like, oh no, I'm selling everything. And then you walk out at a loss. What people don't realize is billionaires on Wall Street lose billions. Millionaires on Wall Street lose millions. Thousandaires on Wall Street lose thousands, but we're in it for the long term. So when Elon Musk lost $15 billion a couple of weeks ago, did he take all his money out the stock market? No, because the stock went up. Like you have cycles, you have waves, and you just have to run with those. Not knowing the difference between trading and investing. Investing is long-term. Trading is short-term. We are investors. This is investing for independence, not trading for independence. So we are long-term, and that comes with a whole different mindset, a whole different strategy, understanding the company, whereas trading is all technicals or mostly technicals and understanding charts and studies, you know, anyway. Trying to time the market. Yeah. Many have tried, everyone has failed. You may hit a lick, like I said, you may get in and catch that GameStop run and make a couple coins, but there's more people that lost on that GameStop run than won. So don't try to time the market. It's do your due diligence and keep time in the market. Don't speculate on stocks. Educate yourself. Overcomplicating investing. It's really like the Don Dada says, it's not rocket science. The guy with the 160 IQ or the girl with the 160 IQ is not going to beat the person with the 130 IQ. That's not how it works. You just need to do your due diligence, do your homework. Failing to diversify, we talked about that. You don't want to put all your eggs in one basket. Stop listening to these YouTubers, these Reddit people to try to think that's going to be your retirement money or your way to wealth. Again, there's a lot of trickery out here. There's a lot of things called discords that are out here pumping stocks so that you could run in and buy, and then they dump to drive the price up, and then they dump and come out, and then you're left holding the bag. So please, this is why it was critical for me to do this course, because so many of us are out here in this Robinhood platform, not knowing what the heck we're doing and losing money hand over fist. Ooh, and it hurts me. It really does. So anyway, buying based on dividend yield. So we talked about dividends and how those pay out. But the one thing I will say, fewer and fewer companies are offering dividends. Dividends used to be a big thing of the past, but now with you know, it hits their bottom line. So there's a lot of companies, like I said, Boeing actually stopped after their drastic downturn last year. They cut out dividends. Dividends are not guaranteed. You can't count on that money. A company could pull dividends at any time they want. Only focusing on price earning ratios. We didn't even discuss price earning ratios. I gave you guys the top 3, I think it was top 3 things to look at before making a sound investment. Price earning ratios is a thing of the past. You can look that up. I may talk about it in a later course, but it's really not necessary anymore. You want to know the valuation. You want to know the price performance. You want to understand the management. You want to understand the company just at a basic level and make sound decisions. We don't invest on margin. Margin just means credit at a brokerage firm. No reason to do that. And people have gotten bit really hard, especially if you're doing short-term trading. And margin is like a credit card. You have to pay interest on it. And no need to cut into your interest that you're making in the market. Just, you know, invest what you have. And we already talked about investing based on emotion. We don't do that. We don't do that. And you know what? Listen, I ain't gonna lie. Emotions is real. Oh, we'll get to that in a second, but you just got to manage them. We also have to understand that Wall Street has red days. This is my watch list from the last class. I could have probably done another one from last week, but I didn't think to. This was when the market started consolidating, correcting, which turned into a bear market. So bear means the market's going down, bull means the market's going up. Almost each and every one of my stocks was in the red, right? And these aren't all stocks that I'm invested in. These are stocks on my watch list that I pay close attention to. But you know what? This was a day where if you have the capital, you're like, okay, what am I buying today? There's a sale on Wall Street. Oh my goodness, Apple's on sale. Oh my gosh, Apple's $115 a share. Get the heck out of here. You know, so this is the mindset that we have to train ourselves on. There's going to be red days on Wall Street. It's just what it is. And once you understand that and comprehend that, but you know you've done your homework and you understand the company, then red days are good days, which is at the top of the chart. This was a red day. This was a good day. And that's part of the woke investor mindset. And that's what Uncle Warren talks about with not having, you know, price fluctuation and not having the stomach for it. Man, there's enough information out in Wall Street for you to totally get those emotion in checks. And yeah, your stomach may flutter, like if you see your portfolio go down 40% at one time, but the understanding is this is a good time for me to dollar cost average, hence the slide. So what is dollar cost averaging? I'm gonna read it just so everyone understands it. The concept of dollar cost averaging is simple. You pick some stocks, figure out how much you can afford to invest, and then commit to buying shares at preset intervals. So rather that's quarterly, monthly, bi-monthly, whatever that is, you're committing to buying those shares at certain intervals. So say you decide you want to buy Netflix and could dedicate $200 every 2 weeks towards its share. Technically, $200 isn't enough to buy a full share of Netflix right now, but you can buy fractional shares instead. And this is the only thing I see, the only thing I like about fractional shares. I don't like people owning fractional shares of this company, that company, this company, that company. But if you're dollar cost averaging, so your fractional shares are becoming full shares, that's a beautiful thing. So in the case that you buy these fractional shares, you buy Netflix every other week, regardless of the price it's trading at on that day you purchase the shares. The idea behind dollar cost averaging is that while you might overpay for shares some weeks, you'll also underpay for other weeks. That's because the market fluctuates. All told, things should all work out in your favor so that you're ultimately paying a lower price per share all in. So that's dollar cost averaging. And we already went over, I think I might have put this here to always remember and never forget these things. So please always remember and never forget. We already went over it. Let me get through the slides. Woke investors think big. Woke investors plan smart. So the next part of your investment plan is really talking about the slides that are coming up. You want to have specific goals. You want to have SMART stands for specific, measurable, achievable, realistic, and timely. You want to have specific goals towards your investment plan. You want to have measurable goals towards your investment plan. You want to have achievable goals. You want to have realistic goals and timely goals. A SMART plan incorporates all of these criteria to help focus your efforts and increasing the chance of you achieving these goals. And what does that look like? So here's an example. This isn't my investment plan, but it's something that I put together so that you guys can get a sense of what an investment plan looks like. And this is very top line. Like I journal, you know, I write down before I take every trade. I make sure it aligns with my investment plan, excuse me, my investments. Because trading is separate, but I also have a journal for that. But anyway, you want to know, what are you investing for? So example 1, I'm investing to pay off my entire mortgage. Example 2, I'm investing so that I can roam the world off of the interest that I make from my investments. And so what does that look like in the in a sentence, right? I investing for the long term, so it's timely, right? I want more control over how I spend my time. I also want to generate, well, this was something else. Another example, like I want to generate an endowment fund for my mother's, in my mother's name at her college. So you have, that's SMART. It's specific, it's timely, it's measurable, it's specific, measurable. A is
Achievable.
There we go. It's realistic and it's timely. That has to be part of your investment plan. You can't say, I want to retire in 2 years. If you know you only gonna put $50 a month away, you know, that's just not gonna happen. So it has to make sense. You also have to list how much you're willing to commit. Example 1, I'm investing $100 or $1,000 each month. Example number 2, I'm investing 25% or 50% of my income each payday. So maybe your income fluctuates and you know you can put a certain percentage away, then that should be what you're committing to. You also want to know how involved. You have to be truthful with how involved you want to be as an investor. Example 1 is supposed to say active. Active, I am willing to do the work and understand the companies that I am investing in. It's the best way to do it, but I also know not everyone's gonna do that. But again, what did I say last week? Passive is better than inactive. So for example number 2, passive, I just want to set it and forget it. That's when you're going to look at funds, the funds that Uncle Warren talked about, like tracking the S&P 500, but I also say track the NASDAQ. You know, the NASDAQ came out 1,000 years after he started investing, and he's really bullish on the S&P, but I also believe tracking the NASDAQ is another wise investment. You also have to be honest with how much risk you can tolerate, and based on and you have to base it on your growth, right? So if you want high rewards, your risk has to be a little higher than just, you know, set it and forget it and easy, right? So example number 1, I am risk averse, but I want my money to grow faster than the bank. So if you're cool with that, if you're like, you know what, I just want to get 8% every year, beautiful. Large cap stocks is the way to go. You know, that is pretty much your way, after you do the due diligence and research those companies, your ways to know you'll beat the banks, right? Or feel confident that you'll beat the banks. Number 2, I am risk tolerant because I have 10 years or more before I will need to access or want higher returns. Like they're saying now, people who are investing in Bitcoin, if you plan to cash out in less than 10 years, don't even buy it. It don't even make sense because the real growth probably won't have, you'll be mad, let's just say. And there'll be fluctuations. But it's the same with stocks. The more time you have in the market, the more risky you can be in the market. So if you have 10 years or more, you want to have higher returns, and I'm looking at some small caps, I'm looking at some mid caps, I may even look at some micro caps if I've done the homework and I believe in the future of this company. You have to definitely make sure you have your time frame wrapped in a bow. So you need to know, I'm not going to touch this money. And you can have multiple accounts and you can have multiple goals for investing. Like you don't have to have one goal for investing. You have multiple goals. You could also have multiple accounts. You can have a shorter term account. You can have a longer term account, but make sure you have the goals and you do the smart strategy with each one of those. So a smart investment plan, I'm investing $1,000 in a month in my All Mine account. And I highly recommend it. Works for me mentally. So I know what the accounts are for. You name your accounts. You could even do it in your brokerage account. You could put the title. Like one of mine is a frolicking fund. Like that's my account where when outdoor opens and they let us back out to play safely, 10 years, however long it'll be, I want to just be able to frolic without, and all I will live off of this frolicking fund. Like there's other funds, other accounts that I have, but this is specifically for frolicking. So name it, whatever it is, if it's paying off your mortgage, if it's paying your student, your student loans, if it's paying your children's, college tuition, whatever, just make sure you put some, even though the streets are, the Wall Streets aren't emotional, you want to have a connection to what you're doing so you stay honest and tried and true with it. And so also with how involved, I put this down because you want to write down how long you're going to invest in this time. If you are an active investor, you commit to being an active investor, which includes spending at least X amount of hours each week. And I'm going to use the woke strategy, understanding that education and knowledge was what's going to lead me to, these streets of independence. Also know your why before you buy. Here's an example about Apple. Apple, I'm real bullish on. I love the company. I don't have an Apple phone, but I have an iPad. I have a MacBook. And I'm real bullish on the direction of the company. I love the leadership of the company. I believe that just based on and I'll just go through my why. This is part of my why. My why is like 3 pages long, and written out, so a lot more in depth in this, but this is just an example. So when you write out your why, like the format the flow to follow. So Apple pays dividends, which is part of my strategy. I do have a dividend strategy for certain companies. It's not a big part of my strategy. There are certain companies that I want to own thousands of shares in, and they all pay dividends. Now, will they pay dividends when I get to those thousands upon thousands of shares? I don't know. But right now, it's part of my strategy. It's also a large mega cap company, which is less risky and also part of my strategy. Apple is a leader in the technology industry, and I'm bullish and expect the stocks to increase on Apple. I'm bullish on Apple because over the last 10 years, the stock has grown X%. The last 5 years, it grew X%. The last 3 years, it grew X%. And if you look at Apple's numbers, I purposely didn't put it down there because I want you to do your own due diligence if you decide you are interested in Apple. But the numbers are staggering. It is part of the big tech stock companies that have outperformed others in the category. The management has been stable under the leadership of Tim Cook and not many hiccups along the way. There have been very few. A couple phones have burned. They've had something, with 5G. They have some regulatory things that they're going to have to deal with the feds. And knowing all of this, am I worried about it? No, because Apple is a necessary product in our culture. Like, it's just what it is. And the feds may hate them because they say there's a monopoly or whatever. Apple's not going anywhere. It's just not. And they also have government contracts. So yeah, that's another thing we need to check in. Like, you need to know what big money is buying. Also, Warren Buffett, I think, owns the largest % share of Apple. Now, all of this stuff is in my big thesis, but this is just a at-a-glance overview. And so the company has proven success on a global scale. I traditionally only invest in global companies because that gives me a sense of security, knowing if one economy collapses. There's a whole bunch of other economies. So Apple is very strong in Asia, very strong in Europe, in India. The phones are like double or triple what we pay here, very strong in India. So there's just global for me is part of my strategy. I'm not supposed to be talking about me. Wait a minute. And based on their innovations, like creating their own chip, I'm big into the semiconductor space. I believe chips is the way to go. Everything we do moving forward will require chips. And so Apple creating their own and not being dependent or self-reliant on other companies is huge. They're also developing an Apple car. Do you know how that thing is gonna sell out when it first comes out? That may be 5-10 years down the road, but still, I'm gonna be in it before that stock just catapults. They're expanding their portfolio of devices. And if you look at the list of devices that they are profitable in, from the iCloud to the wearable tech to the health fitness, I mean, it's just, the list just goes on and on and on. The App Store, oh my gosh. They're poised for continued growth. They are also hiring in decent numbers, which is always a strength of a company. If a company doesn't have jobs listed and all you're hearing is them laying off, that could be somewhat problematic. Just do your homework. The success of the iCloud and their iOS platform, according to the latest press release dated January 1st, revenues are up quarter over quarter. But I will set alerts to stay updated on their meetings with the US government and Facebook. There were some issues with Facebook that I think are still happening. So I have alerts set, Google alerts set, to be notified of those things. Talked about emotions real quick. Emotions are real. I don't want to sound like, as you become a new investor or even more seasoned investors, don't go through emotional phases in the market. But one way to conquer them is to write them down. So again, example, today was the first day that I saw 3 of my stocks drop and my portfolio dipped 10%. But I feel good about my research and I feel good about the company selected. So I just need to stick to the script. Something like that could literally do wonders. But as soon as you feel your heart fluttering, palpitating, or you feel like you need to come out the market, write it down, see if, and then refer to your thesis. If there's anything in that thesis that changed, then you investigate further. If not, you just write down your emotions and keep it moving. Another example, dang, my portfolio is looking good right now. I'm tempted to sell my stocks and buy that new HD, 4D, HD TV I've been eyeing at Best Buy, and Best Buy has it on sale. I know that it's not part of the plan, so I will not sell my shares prematurely and stick to the script. There's all types of emotions that you're going to face, especially when that portfolio is green too. You're going to be tempted to buy whatever liability that you've been eyeing, and then you'll regret it later. So just write down your emotions. And what is the plan? I mean, what is the formula? You plan, you strategize, you execute, and then you keep calm and stick to the plan. It's really, I'm telling you, when I look at the stocks that I purchased in the early 2000s and where they are now all of them weren't winners, facts. But the winners heavily outweighed any of the non-winners, so, or the losers, or the the laggards, as they say. But if you keep calm and stick to the plan after you've done your homework and your due diligence, you are ahead of the game. I'm not going to read this because this is stuff we went over, but this is kind of like leave behind for you to read at your own time. But it talks about the advantages of a concentrated portfolio. It talks about diversity and focusing on high quality investments. But again, you could read that on your own. Now, quickly, show and tell time. I shared this on the Facebook page. I also shared this in the last class, but this was an IRA that I didn't even know existed. Literally, TD Ameritrade have been trying to contact me, but I still get mail. I don't like mail. I don't go through all my mail. And I thought it was just statements, right? They have been trying to contact me for a long time. I had to call them about something. They're like, oh, we've been trying to contact you about this IRA. What do you want to do with it? I'm like, no, I have an IRA. They're like, no, you have another IRA. And I had no idea that it was just sitting there. Now, if you look at what I outlined, June 16th, it was at $2,290-ish. It was just sitting there, not moving. not moving at all, just flatlined. Had no idea my little $2,000 from God knows where, old IRA, was just sitting there. That means whatever fund it was in probably liquidated, and I think that's what happened, and I just didn't reinvest. I didn't know to reinvest. But then look at 2018. The thing went down without me doing anything. I didn't even know about it. I didn't know about this IRA until the end of last year. So with me not doing anything, it lost value, which is insane. But then in November of last year, after doing due diligence, my research, I also, understand options, but I don't make moves in that area either without doing my research. November 24th, 2020, it was at 2,100, what's that, 33, whatever. Now keep in mind, IRAs, I can't, this is already pre-tax. I can't add to it. It just gotta do, not this IRA. I just have to grow it. So wait, can I? There's some type of restrictions, like because of pre-tax, post-tax, I forgot what they are. But long story short, I haven't put any money in this account, made my move in November. Then here we are, what was this? February 8th. My account went from 2,133 to 6,478. The current value at that time was over 6,000. And this is February 8th. So from November 24th to February 8th, my account tripled from the stock market. Let's look at a more new recent example. And I purposely am not including stocks because I don't want everybody to do their own homework, pick their own stocks. So this is an account that literally in 38 short days has grown 29%. This is a small account, and I listed what the investment was. I started this account for my great niece, and literally have a limited amount that I'm going to be putting away every month. And started out with $433.98. The account in 38 days grew to $554.64. It's diversified with a heavy concentration in stock. I'm heavy in stock with a lot of my investments. And heavy in tech. Because I believe tech is the future. So that's just my strategy. Now, I told y'all about the account that my brother is managing for my other niece. And this, I'm just showing you the bar chart. So this was, oh, did I not put the date here? Well, this is the 1 year return rate of return. And it compares it to the S&P 500 index. It compares it to the Barclays, and Barclays aggregated bonds and 3-month treasury. He was able to grow this portfolio by 730, and it went higher than that. Actually, this was the screenshot I grabbed. It was in the 800s at one time. It may have been higher. I don't check it every day, but this is just to show you that this is a riskier portfolio. It's very concentrated. I don't even know if there were 2 stocks in there one time. I think there may be 3 or 4 now, but when this was taken, it was 2 stocks. And they were growth stocks. Small cap stocks. So again, but understanding that his daughter has a lot of years ahead of her, those type of investments make sense, and they sometimes can pay off sooner than later. But if you he did his research, he did the homework on the companies that he wanted to invest in, and those are the type of results he got. So before we get into the brokerage accounts, again, are there any questions about anything? Okay.
Oh, wait, hold on. I'm always thinking I have my mute off. I'm so sorry, guys. I just want to, on that account that you had that moved out very, once you paid attention to it, you said that was an IRA and you just moved and okay. And
I decided to self-manage it using mostly options, but some shares of stock, but yeah.
Okay.
And just to give I was very concentrated in that. I'm real bullish on semiconductors, as I mentioned, and those options trades that I made were either ETFs or companies that are focused in the semiconductor space.
I got it. Okay. Thank you so much.
You're welcome. Okay, so back to the brokerage section of the investing for independent strategy. We already went over the questions you should ask based on, the broker that you decide to go with, but all of the best in class brokers, you can check yes off of all of these. They all have customer service numbers. They all have access to funds if needed, including checks and debit cards. I'm not sure about international brokerage, but the rest of them do. They all have desktop, web, mobile, and you can designate beneficiary. So we're just going to go to the next slide. Hello? Okay. Also with the best in breed, best in class, we went over those and understanding that the ones that are tied to big banks, you should sleep easier at night. You're not worried about somebody running off with your money. Morgan Stanley owns E-Trade. Charles Schwab's owns TD Ameritrade. Interactive Brokers acquired Goldman Sachs retail brokerage account. So they're in partnership with Goldman Sachs, which is if not the largest big bank, it is close to it. And Merrill Edge is owned by Bank of America. Fidelity is the only one sitting out there on its lonesome, but it's one of the top banks too. They have $1 gazillion in assets. So you all received the link to stockbrokers.com, where you can do a side-by-side comparison of these do-it-yourself brokers. The only one that's not listed here is Charles Schwab, but you could just look at TD Ameritrade since they now own TD Ameritrade and since I am part of TD Ameritrade, the understanding is that they're going to transfer all of their mobile platforms over to Charles Schwab because they have the better of the two. And so by the end of the year, there will be no more TD Ameritrade solely. It may be Charles Schwab Ameritrade. I don't know what they're going to name it. But saying all that to say, stockbrokers.com listed them as the winner. Does that mean anything? Am I saying go to TD Ameritrade? No. All of these are really good. Again, I can't speak to Interactive Brokers. I know a couple people that have Interactive Brokers, but I've never even experienced the platform, so I have no idea. But the rest of them are all good. It just depends upon what their needs are. And again, JP Morgan is the largest cap as it relates to banks. And so no worries there. And I'm not going to go over this. This is just more detailed information about full service brokerage accounts versus discount brokerage accounts. There is no one here that I'm aware of. I mentioned during Saturday, I think it was Saturday, I was on the call with a few people, I get them mixed up. But the only people that really need full service brokers account are like CEOs, wealthy people, people that don't mind paying a grip of money for someone to place a trade for you. Most of us can find some time on our phone, especially with everything being mobile now. Once you do your due diligence, your homework, your research, you can find time to do exactly what it is you're paying an exorbitant rate for someone else at a full service broker to do. So that's just more details about those. Now, again, we talked about how to invest in the market. You have to set a budget and a plan. You have to fund the account, select the equities, and focus on the long term. And this is the beginner's toolkit. It's already 9:51, so I'm going to get through the slides and then come back to the links here because I was going to walk you through how to look up your companies and do research. But let's just go ahead. So just a quick, we covered, somebody's not on mute and moving around a lot. So can you mute yourself, please? the recap of what we covered. The woke investor mindset simply means wealth is obtained through knowledge and education. The dire wealth gap and asset allocation that we as Black and Brown people are facing. Talked about how Kobe understood the impact. Let me see if I can mute everybody. Hold on a second. Somebody just refused them now. Can you check, whoever's not on mute, can you please mute yourself? Because you either got your TV on, there's a lot of stuff going on in the background. Okay, oops, sorry. Constant headlines that show we are in a downward trajectory and the urgency is now. We clarified the myths associated with investing and learning the truth that investing is not rocket science and you don't need to be rich to let the market work for you. Learning the history and importance of the stock market, the various exchanges and indexes. Talked about and learned about how a company goes public, referenced my girl Jill and her lemonade stand. If you please watch that again and again, because it will start to make more sense to you the first time. It may seem foreign, but as you learn these phrases and more about the market, it will literally open your eyes. Talked about the benefits of investing, including compound interest, ownership in companies, and more with examples. What to look for in a brokerage firm, what it takes to begin your investment journey, how to create a broad watch list and drill down to a more focused, narrow watch list, the benefits of diversification, the benefits of concentration, best-in-class brokerage firms, various types of accounts available and process for opening, stay away from the devil, which rhymes with Bob and Good. I guess you could figure that out. We talked about the 42 terms, woke terms that every investor should know and understand, the importance of market capitalization and the outstanding shares when evaluating a company. We reviewed long-term, short-term capital gains and losses and tax implications, various research sources, which some have been sent, some are in this presentation, and the importance of mindset management and developing an investment plan. A lot of you, when you started, you barely able to crawl through this process. Hopefully by the time you finish all the assignments, you are upright and you're able to walk. The next steps will be able to, hopefully, if this is your journey, you'll be able to run and fly. But as long as you're walking, whoo, you're ahead of the game. I just have to do a quick honorable mention to the Cottons because they literally sent their homework in record time. So I just want to shout you out. That was the quickest. Hey. So shout out to you guys. Congratulations. I also want to let you know about our woke community. So yes, no, this is completely free. I am not asking you to purchase anything. I do want you to be part of the community, and part of my mission for starting this little, collection is that it promotes conversation. And there's a lot of times where you could sit down and try to talk to somebody about the market and they won't listen. But something as simple as somebody says, "What'd your shirt say?" Wealth obtained through knowledge, they'll be more apt to listen. So again, this is a community, this is a platform where, again, my goal is not to stop with the 200, but 200 is my target for 2021, but I expect to 10x that for 2022. And I want you guys to come along for the ride and help to bring people in the market. So there is a Teesprings account. This link will be, I posted on the Facebook page too, but this will be in the presentation as well. And these are some of our models. Some people also bought, but they didn't model for me. They just sent me pictures of the shirts. And there's various colors. There's even pillow, whatever, hoodies and all of that. So your woke wealth journey has officially begun. What is next? Oops. These are just some posts that I put during the first class, but they really resonate with what I want everybody to walk away with. There's a saying that the devil's in the details, but no, the dollars are in the details. If you do your homework, if you learn your companies, you will watch your money grow. I mean, it's just what it is. And now that you're interested, it's time for you to be consistent. I don't want this call to be the last call. Some people will join us on Saturday. Some people will walk away and I'll never hear from you again. Some people will walk away, make moves, but not join. But please keep me posted on your journey, your growth. I want to know how you're doing. I want to know if you've opened that brokerage account. I want to know if you started becoming active. And I always say, if nothing else, even if you can't fund it right now, open a brokerage account. Start doing the research. Like TD Ameritrade, all you have to do is open an account and you have access to so much research that you know, people pay for. So please make that a priority. Many people don't focus enough on execution. If you make the commitment to get something done, you need to follow through on that commitment. And this is by Ken Chenault, who's the former CEO of American Express, brother who is just brilliant, and it's all about execution. And this is one of my favorites. Wealthy people invest first and spend what's left. Broke people spend first and invest what's left. And with this stimulus money, with these tax returns, if you're not investing that in the market, and I posted in audio, you're literally losing money. You're losing money. And not saying all of it can go there. There are probably obligations, but find money somewhere to start this journey. Just please. April is National Financial Literacy Awareness Month. President Barack Obama designated April as National Financial Literacy Month, excuse me. And then here was his quote: "Now, therefore, I, Barack Obama, President of the United States of America, by virtue of the authority vested in me by the Constitution of the laws of the United States, do hereby proclaim April 2011 as National Financial Literacy Month. I call upon all Americans to observe this month with programs and activities to improve their understanding of financial principles and practices." So in honor of April being Financial Literacy Awareness Month, or Literacy Month, which was created by our beloved Barack Obama, President Barack Obama, I will be having 2 cohorts in April. The first cohort will be April 5th and April 12th, once again on Mondays. The second cohort will be April 19th and April 26th. I will not have the separate Q&As. If someone joins the first cohort and needs refreshers, they could always come to join the second cohort. You guys are more than welcome to come back. You can, just send me an email that you want to join, or, just send me an email. And then you could pass the word on to other people so they can at least sign up to get more information, because they are going to have to answer those questions. I am also going to invite some of you for the next level. Now, not everybody's ready for this, but I do believe, if you look at that portfolio that I was able to go from 2,000 to 6,000 in 2.5, 3 months, whatever, it wasn't 3 months, February, March, November, December, January. Okay, 3 months, less than 3 months. A lot of it had to do with this man right here, Mark Monroe, who's a mentor, who actually was our commencement speaker last month. Next month, we are going to have another graduation, but it's going to be more of a collective with the April and March cohorts. And we do have a guest speaker lined up, so more about that. But Mark Monroe is a self-made multi-hundred millionaire who is literally teaching our culture and our community how to create walk-away money, how to literally invest so that within 5 years, 10 years, you can literally achieve your dream of walking away. And it's through options trading. And options, the money's just different. And so he walked us through what that looks like. I will send the link to last month's graduation for the new people, so you can watch it and learn from it. But again, you would not have been able to even become part of his circle without understanding the basics. So I want to at first introduce you to the basics so you can move on to the next level when you're ready. So I would like for you to become a Come Up Cousin, which is the name of his movement. And every Tuesday and Thursday, he goes live on YouTube. There's a starter pack to get started. That will be in the email that I sent as well. But it teaches us how we can literally change the trajectory of our negative wealth in one generation. I want you to continue to learn. I want you to sign up for next week's reunion, which is open to everyone who's, taking this course. But the people from last month, we're going to gather along with the people from this month and just talk about where we are. It's no slides. It's really no slides. If there's things you want me to go over, I will. But it's more of a conversation to see where we are, where we need help, what wins we've had, and just to celebrate each other. And with that, I want each one to teach one. I talked about my vision, and my vision is going to remain until I meet this goal of 200, and then I will expand it for the next year, or maybe later in this year, depending on when I reach the 200. But I'm also, there have been people who know that I trade that want me to help either with the Come Up Series trading strategy and or options trading. And so I'm hosting 2 classes, and they're mini classes. Hold on a second. Sorry. Is Cedric still on here? Hold on a second. Cedric, I'm a mute. I'm gonna call you. Sorry about that. So I am offering small sessions, and when I say small, literally, there's 5 people per session. I think the Sunday, I don't know if it's sold out. Somebody wants me to hold a spot. I'm not sure if it's sold out yet. But the Thursday class, I think there's 2 more spots available, and we'll go over reviewing strike price formulas, how to review premiums, and walk through buying calls with live demonstrations. We'll use both the TD Ameritrade and E-Trade platforms, and each attendee will be able to provide at least one, not supposed to say one stock for demonstration. Depending on how much time we have, we'll do more than one. And next month for National Financial Literacy Month, I'll host at least 2 advanced courses during the month of April for anyone who's interested. Again, these will happen with 1 person at minimum, but just for people who need a little bit more advanced strategy. I will email again and post when those happen. And then there's people that, definitely, may need some more, coaching or accountability, and that's fine, but it's not free. So if you're interested, there's a booking page on the website, and that's just me helping you do research for your companies, making sure you're on the right track, but it's more specific to you. Like it's all about you, and not broad like we're speaking now. But again, my commitment is to make sure you have the basics for investing, and that's pretty much what I want. And if there's anything extra, we can work to make that happen. And so let's make some good trouble, y'all. When you see something that is not right, not fair, not just, you have to speak up, you have to say something, but more importantly, you have to do something. And those are from the man, the ancestor, Representative John Lewis, who spent his whole life just doing just that. And then from my bay, empowered people empower people. So share the information and share the website, and tell a friend to tell a friend. And we're ending with, it's the independence for me. Like I just literally believe, as Cedric said, how the rich stay rich. That's exactly what I'm trying to, accomplish. Not just, me getting to the wealthy, but also maintaining it for generations. And you did it, y'all. And like I said, a combined graduation will take place next month. More information to come. And that's the closing bell. Ding, 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 ding. Thank you all. Thank you so much. Let me know if you want me to go over those links. And if you do, I will. If not, oh, Yolanda, I know you said you wanted the I don't know, you still here? Let me stop sharing. Hold on.
Yes, I'm still here.